0.46 of 1%.
Correct.
Yeah.
Right. Yeah.
0.46%.
Again, that's within a range that's been reviewed at 0.45 to 0.50 is a reasonable range of fees.
Oh, great. Good morning.
Good morning.
Hi, everyone.
This is Mark Romano. This is side of the 4C. He's from Pimco. Turn it over to you.
Great. Thanks. Thank you. I think you go down that way. Let me know if you need more.
As Mark's passing those out, just a brief introduction. We've had an opportunity to speak with Mark over the telephone with Tim Knudsen and myself. And this is from Pimco, I think a demonstration of the client relationship that they have. And Mark's willingness, I know, in a very busy schedule with very short notice to come up here and introduce Pimco to us this morning. We also thought it was important, given in our fixed income category, when we're looking at an investment amount of $35 to $40 million roughly, is that it's important for you to get an opportunity to get to know Pimco and their representatives. So.
Great. Well, thanks, Jim. Good to meet, put the face with the name. We've only met via phone, but yes, I'm here today to discuss PIMCO, which stands for Pacific Investment Management Company. And I'll certainly give you some background on what we do and how we've done it. We've been around since 1971. But I would imagine that any discussion today would not be complete without at least acknowledging what's going on in the financial markets. And I myself have a background in bond management for 26 years. So we've never seen anything like this. The good news, I'll just cut to the chase, is PIMCO is doing very well through all this. We really sidestepped a lot of the issues that came about because of the subprime problems and so on. It's probably why we're being invited to quite a few meetings like this these days. It's not easy being a bond manager, and a lot of our good historic competitors are really feeling problems right now. So with that, I'll ask you to maybe interrupt me throughout the meeting if you have any questions. And Jim, I don't know if we decided on the duration of how long I should go, but maybe I should get a hint from you on how long. Half hour?
Was that enough time?
That's plenty, yeah. Good. Well, let me lead you through a few key pages on what we do and how we do it, but I'll start with page 3 here, which is what we think in discussing with Jim what your objectives are for discussing this today, and that is to work with what's called a core plus style of bond management. It's something that we kind of invented. We've been around for a while. We have a lot of copycat people that do what we do now, but back when we started the firm in 1971, the idea of core plus bond management was a little bit new. Core bond management is simply investing in mortgages, corporates, and treasuries, just those 3 areas of the bond market. What we found that over time is if you introduce other areas such as emerging markets or non-US or high yield or other areas of the bond market that develop, another one would be TIPS or Treasury inflation protected securities. These tend to allow you to increase the returns that you can get in a bond portfolio, and somewhat, I guess illogically, also reduce the risk, because these other types of plus bonds, adding them to the core, actually are uncorrelated with the core bonds, and so it drives down the risk a little bit, yet increases the return. And because of that idea being very popular, we've, we're kind of the grandfather of this strategy, but certainly there's a lot of other bond managers that do this now. It's probably the most common type of bond management out there. The record that we have on page 4, and this goes back to the inception of the Total Return Fund, that it's the mutual fund that you would consider if you were going to hire us. It's an institutional fund. It's meant for investors like yourselves. It has a $5 million minimum. And the record here is quite amazing. What shows here, this graph on the right side, is the diagonal line is the index of bonds. Today it's called the Barclays Capital U.S. Aggregate Bond Index. Just to show you how strange a year it's been in the bond market. Ever since the bond market had an index, it was called the Lehman Brothers Index. And we know all what happened with Lehman Brothers this year. So now it's called the Barclays Capital because Barclays bought that part of Lehman. But anyway, the diagonal line represents the index. Any diamond above that index means you're outperforming it. And this is after fees. Notice, number 1, that 71 out of the 74 time periods were above the benchmark. And again, this is what clients are receiving. This is after fees. But probably just as important, and especially important for a bond investor like yourselves, is what happens when you get it wrong. And you take a look at the several periods where we're below the line, but look how modest that is. Look how close that is to the line. Let's face it, when things go wrong in the markets, like they are now, I'm not sure what your equity allocations are, but whatever they are, unless you have all your money with a short manager instead of a long manager, you're suffering on your equity. You want your bond manager to be in a position where it's actually helping your overall portfolio. And that's how we run the firm. We understand that we're the lower risk provider. The bonds are not meant to get a lot of extra return. They're meant to be a very safe component of your overall portfolio, but one that can beat this index modestly over time and consistently. So that's one point I want to make here. The downside that we've experienced for clients is quite modest when we don't beat the benchmark. Secondly, you notice that this bottom, or the x-axis on this chart, is actually the return of the index. So if you're on the right side of this chart, that's when bonds are providing returns, if you were to draw a line up, of 13, 12%. These would be time periods. I know that sounds absurd, 13% on bonds, but those would be time periods when interest rates are falling and bond prices are rising. And you notice we're above the line when that occurs. But just the same when bonds don't do that well, when they're down in the 2% range in total return. So these would be time periods when actually interest rates are rising and bond prices falling. Again, we're above the line. So I also think that's important for someone considering a bond manager. How do you do in different environments of what you're presented with as an investor in these markets? So real good record. We'll dig into a couple of other facts on page 5. As I mentioned, we've got a lot of history coming up soon on 40 years of history. We manage right now about $790 billion in assets. That's a big number. We are the largest bond manager in the globe, on the globe. We have offices, 10 offices globally. And when I started the firm, which was 1997, we really were domestically focused. We had offices in London and Japan, but back then it was not a global world for the bond market. Those were basically client service offices. Now we have 10 offices and there are portfolio managers in every one. Why? Well, you think about what's going on with